Hello everyone, how are you today? This is Gilbert Jalad. I'm talking to you here from CPLSPA downtown Orlando. This is Tufts on Tax, where all your tax issues are discussed right here with Mr. T. Scott Tufts. He's the master and the expert when it comes to taxes and tax laws. Hello Scott, how are you today?
Good to be with you.
Good to be with you too. Now today also, as usual, we have these unique subjects, and I see here an article that you wrote a while back, probably in 2004, and it starts with, "It ain't over until it's over."
Right.
So can you tell us a little bit about that?
Yeah, so the with an ode to Yogi Berra. I guess we're doing Celebrity Month, but anyway,
we started with Frank Sinatra.
With Frank Sinatra, right? So now we're looking at Yogi Berra's comment made about the Miracle Mets, where they were way behind in the pennant race, and the reporter allegedly came up to him and said, "You know, what you guys are so far behind," and he came up with this quip, "It ain't over till it's over." And he's kind of famous for these kind of interesting quips or comments that people then have repeated over the years.
It's catchy.
Yeah, so I used it for an article in 2004 that's kind of technical, which you would expect from me. But the subtitle is "When Partnership Tax Vessels Make Ill-Advised Journeys and Wind Up at Harbor Cove." So using an analogy of tax vessels or a partnership entity being like a boat, if you will, or yacht, and it ends up at a marina. And the reason why I'm using the analogy is, if you think of a boat with people on board, those might be partners, and the boat itself might be an entity. Mm-hmm. And the question becomes, and this is very prevalent today, when the entity is kind of nearing the end of its journey, it might pull up to a dock, and the partners may want to get off, and that's it. And they take it out of the water, mm-hmm. and it's done, and it never sails again.
And that happens a lot.
Right. So the interesting thing for partnerships, though, is what happens if the people that are in charge of the boat, right, tell maybe one of them, get off, and he says, I'm not going to leave. And they say, well, we're going to force you to leave. Mm-hmm. We're going to help escort you off the boat, okay? Because we have another boat ready to set sail, and we're going to all jump on it, but you ain't coming with us. And here's your check. Thank you for your ride, right? Mm-hmm. Here's what we think your interest is in the boat, your percentage interest. Bye-bye. Mm-hmm. And he said, well, that ain't right. Mm-hmm. So in this case called Harbor Cove Marina, mm-hmm. this very small percentage partner, when they handed him a check, did not cash the check and spend it. He put it in an escrow account and saw a lawyer. Meanwhile, they all get off the boat and jump on another boat and take off without him, proverbially speaking. Mm-hmm, mm-hmm. See what's going on? And he says, well, just think of it this way. You get off the boat,
yeah,
and you think you're worth, that percentage interest is worth, throw a number in there, 300,000. Mm-hmm. And they give you a check for 25,000. Mm. And you say, I'm going to contest that. That's not fair. And they say, too bad. We're jumping into another boat and keep on cruising. Now, if we're talking about partnership entities, did that partnership end? Right? That partnership with all those guys on board.
They forced it to end.
Yes, and they
on
jumped,
one side.
But they went sailing some more. They went boating some more. They kept going.
So they had an interest in another partnership to hop on. But isn't that in the contracts?
Right. So they look at very good. So they look at the contract, and he said they didn't comply with the contract. So that's why he went to a lawyer. Exactly. That's why he put the check that they gave him in an escrow account, didn't spend it, and then he went to court and sued him. So okay. Good. So far, so good? So what's this got to do with taxes?
Yeah, I was just going to ask that.
All right. Well, when they went to pull up the dock and end the partnership's journey, they filed a final tax return. Right?
They filed.
They did. And said, here's your K1. So he gets his check, and he gets a K1 that's marked final.
So they're making all the calls.
Exactly. So what do you think he did? We should know by now that if he's already put his money in escrow, and he's going to sue him, and he's only a little small percentage partner, he also knew, because he got good advice, to file 8082, the Form 8082,
Yeah.
and said it ain't
We talked
final,
about that.
right? And so they go to court, they go to tax court on that. Now, if you follow what's going on, they're suing in state court over he didn't get enough money, right? They didn't end his interest properly, correct? They didn't comply with the agreement. This is what he's alleging. And then tax-wise, he files an 8082 and takes them to tax court on that. Now, you might be thinking, well, okay, so what's the intrigue about this? Well, court takes time, right, Gilbert? So maybe it's 3, 4, 5 years later, right?
Yeah.
He's not getting any more K1s, right?
No.
Okay. But he put that money in escrow, correct?
Correct.
They went off sailing on a new boat, or boating on a new boat, which is a new partnership entity.
Does he have to pay tax for that?
No, wait do you see this? This is great. He contests it by the 8082, right?
Yeah.
Every year while they're boating in their new partnership entity, that other one, let me ask you this. Do you think that other one is finished its journey and it's over?
No.
Exactly, because he didn't spend that money.
Yeah.
He safeguarded it and contested what they were doing. Bottom line is, in state court, many years later, they say he's right, they're wrong, and they said, it's not, you got to pay him more money. See what's going on? And so they say you got to give him a new check, and everything you did was wrong. Right? Now, we're 5, 6 years later. Guess what? Because he filed 8082, they had to file a partnership return every year after that.
And if they didn't?
They get penalized.
Oh, for every year?
Yes.
Wow.
Even better. They didn't do, he contested it, right? They get audited. The partnership.
Wow.
Even better. They got to audit the new partnership and reverse what they did on that one.
Oh, wow.
So you think the people on the new boat are happy?
No, they won't appreciate that.
No, because they're now audited for all these years, along with the partnership.
Because they accepted someone to join in that did not do the right thing.
Well, no, they did not bring him along. They tried to go sailing without him, right? And he put that 8082 in there, and now everything had to be reversed and brought back to the other partnership entity. So why Yogi Berra's "it ain't over till it's over" is this idea that if you don't do things by the book, by the law,
it's not over,
and you know how to use 8082 and you know how to protect your rights, right? If you're talking to the right people, getting good advice about that K1, it was marked final. That doesn't mean it's final. I hand you a K1, it says final. What if you look at it and say, final? I didn't know it was the end.
Yeah, I wasn't informed.
Right? So an 8082 can say, no, I don't agree, right? And even though you're a small percentage owner, outvoted, right? You can fight back.
So that form saved him.
Yes.
Okay.
So if before we were saying with I did it my way is bad, right? Like, don't do the 8082, I'm just going to do it by myself, right? Now we go to the flip side. An example of someone who did it, and look what happened. All right? So this article reminded me of how do you know it's over? How do you know when you can file a final return and a final K1 to your partners? Okay? So let me ask you something. You pull the ship up, proverbially speaking, you're ready to do a final return, but you have a bank account. Do you think you need to close out the bank account before the end of the year?
Not sure.
Okay, so what's over? Well, over is you close out the bank accounts, you have no economic activity.
To cancel that. Okay.
You're not suing in court somewhere, correct?
Yeah.
Because what our accountant friends out there know when they're doing the tax returns is they know that even if you don't have any tax consequence, right, you still may need to file that return, right, to report something, your balance sheet, that you still have money in the bank.
To close the ends.
Right. Many people don't realize that there's a Schedule L or some schedule to the 1065 that has a balance sheet on it. What happens if you still have assets? How can you still have assets if you've closed down? Wouldn't those assets be distributed? So the point is, Gilbert, when you're at the end, right, everything would be zeroed out, correct? The accounts would be closed, yes. Money dispersed, yes. Final means it's over. Not, let's call it over, but we still have some things lingering.
Lingering or hovering or
lawsuits.
Pending.
Lawsuits. Disgruntled partners, members, whatever. Catching on? All right.
Clear it out.
All right. So now why is this? Can this come up? Because I just read this morning, IRS is looking at, they need to provide guidance on when a partnership terminates. When is it over? And there's still confusion out there. Got it? So that's why my article from back in 2004 still resonates now, because we're using the analogy of you pull the boat up, right? Because think about it. Are they getting off the yacht or boat, right, whatever you want to say, and retiring, right? Like truly being done with that? Or have they painted up like Titanic 2, right? And it looks just like Titanic 1, got it? And it goes set sailing, but they left somebody off the boat. They left DiCaprio off this time, right? They're going sailing, and they get rid of the DiCaprio guy.
Going back to the
and they're going back out, and they're going to sail with the rest of the crew, right? I don't know, but you know, you get the idea.
Yeah, I like that analogy.
Yeah, and the idea, Gilbert, also is that all the jewelry and everything went with it. See the analogy? So at what point did it's really the same entity? You just got cute.
I have a question about that.
What's new or what's merged? Right? See what's going on? You start thinking. So I guess what we can kind of sum up on that is, if ship one, proverbially speaking, the Titanic, is moored up and saying that's our final journey, but there's something that looks exactly like it going back out with the same colors, same look, same people, same everything, right? And it set sail. You can't just assume it's over until you examine that a little bit more closely with the tax rules that deal with what's final, what's not, and is there an 8082 out there that is saying not so fast, especially in the example of the article, which was dealing with a check that the guy put and said, I'm not cashing it, I'm putting it in escrow. Okay?
My question was,
Sure.
What causes partners to do that to each other? I mean, what's going on in their mind, and what's the intention to
Gilbert,
sail off?
Come on, Gilbert.
They're trying to. They see the money coming, and it's good.
Okay, come on. Happily married couple go off on a yacht. They're traveling across the the Pacific Ocean. They get along so great. It's going to be wonderful. There's no land in sight and everything, and they're stuck on the boat together. But that's good, right? Maybe after a few days at sea, maybe they don't want to be on the same boat together.
Just by days, huh? Wow, that's a fast one.
But that's a horrible example. But the idea would be partners don't always get along, right, Gilbert?
Yeah.
And they've got to deal with their provisions in their agreement, which you brought up, and it will walk through what the plan is for if there's disagreements. It will walk through what the agreement is as to how you get bought out. it will walk through how you dissolve, or at least it should, correct?
Yeah.
And also, big, it should describe the new BBA, Bipartisan Budget Act, provisions that deal with how entities usually are audited when they're these complex partnerships. So what we want everybody to know is that if you have a operating agreement or partnership agreement that has tax matters partner in it or something like that, that's a warning sign that that agreement may be obsolete, and you need to get it updated to reflect the partnership representative and new terminology for how they're going to audit partnerships. So if you have an older partnership agreement or older operating agreement, you need to be looking at them and look to get them upgraded as well. And that's something that we've done for folks, but other, that you got to get to your lawyer or, and get that revised. So all of these provisions show that these entities are complicated, and there's just, you want to be careful. And don't forget that 8082 if you're on the outside looking in and you need to protect your position. And like we said, you can't ignore these rules because that could be a problem, and so forth. And the other thing, Gilbert, to keep in mind is the statute of limitations. If you're not filing certain forms, the IRS can keep the statute open because you haven't complied, even though there's not a tax issue. So folks get really surprised sometimes with these technical rules where they think a statute of limitations has gone by or whatever. This can kind of say not so fast. All right. So what do you think?
That's a good advice. So it ain't over until it's over. So that would be our cue here to say thank you, folks. You heard Mr. T. Scott Tufts. Pay attention to these things. This form is very important. If you face something like that, don't forget to take this advice. And always call Mr. T. Scott Tufts at 877-647-7887. Again, 877-647-7887, or you can email him at stufts@cplspa.com. It's stufts@cplspa.com. You can visit the website at cplspa.com, and you can view his profile, and we have all the episodes there. We have them on YouTube. We have them on Apple Podcasts as well. Thank you, and have a wonderful day.